After a shaky start to the year, there appears to be some optimism on Wall Street for deal-making in the second half of 2025. For more on the merger pipeline and the IPO market, we want to bring in Stephan Feldgoise. He's global head of M&A at Goldman Sachs. And Stephan, let's talk this through. People were expecting some really big things this year with President Trump coming in, this idea of deregulation, the idea that maybe more deals would get approved more quickly. Didn't happen in the first 3 months, but I think things picked up towards the end of the first half.
It certainly did. And, we just announced our second quarter. I think David was on. We saw volumes for us in the first half were up 50%. The market was up about 30%. At the end of 2023, I thought it was going to be kind of a plus 10 or 15%. 2024, it was kind of in that ballpark. There was still a lot of volatility. Didn't expect it to be robust. I kind of felt the same way going into 25. There was still a lot of things going on in the world that made deals challenging. That being said, the level of dialogue had accelerated. And I think David Dubner was on with you all a number of months ago, and it was then making predictions and talking about what was going to happen. And we really saw dialogue at levels that flowed through in the second quarter. And I'll tell you, those dialogues continue. We looked at 500 million and up deal counts as kind of our focus as we think about our business. We did about 60 in 2023, about 100 in 2024, and it's been about 140 transactions in 2025 year to date. So no more predictions, so to speak. It's kind of flowing through in the numbers, and we saw it in our second quarter.
And where did you see it, both geographically and then what sectors?
It's interesting. The $1 to $5 billion category has been incredibly robust. But in the second quarter, you saw a lot of 10 billion plus transactions come through. In fact, it's been one of the highest 10 billion plus transaction years year to date. So it's really been all sectors, all geographies. We've seen a lot in Europe. Europe's been incredibly active. But really, the $1 to $5 billion category, and we'll talk about private equity in a minute, very corporate, but $1 to $5 billion in the Americas have been incredibly strong.
And you recently reached out, did a survey, I think, of 700 companies where you asked them what they're planning and expecting for the second half of the year. What did you hear back?
So we just published our second half white paper. We went out to about 700 companies, as you said, and well over half are talking about M&A as a core part of their strategy going into the second half of the year. I don't think that's dramatically different from prior years. It's just that the actual number of transactions happening relative to those predictions is what's happening. What's driving it? Is it AI? AI is flowing through every sector.
Yeah.
And so as companies think about how they want to reposition, coming out of COVID, supply chains, scale were critical pieces. Heading into the advent of AI, it's scale, it's technology, it's thinking about how do I take cost out, how do I have broader revenue scale, how do I accumulate data, and not just data, but in an organized way. It's flowing through every transaction.
Although it's funny, the Journal just had a story over the weekend about all of these big deals to go after talent. And maybe by buying the talent, it's circumventing some of the deals that would have gotten done otherwise, a $3 billion deal or something else, where you just take the top talent out and run with it.
Well, we certainly think at Goldman Sachs that talent is everything. And so investing in talent through M&A, through hiring is robust right now. For the top talent, whether it be in M&A, whether it be in AI.
But how much do you think of the deals that aren't happening because there's this sort of acqui-hire approach? It's what they're even describing as reverse acqui-hire, meaning you don't actually buy the company.
Well, we've seen some of that more in technology, I would say. But broadly for the M&A market, it's not just talent, but it's assets, it's scale, it's clients, it's customer. I mean, there's very broad reasons.
In a long-term services world, in an AI-powered world where everybody can individually become Superman, right? Mm-hmm. It does maybe change the dynamic to which you would actually, instead of buying the company that quote-unquote has assets, you'll end up just buying the people. And you may pay astronomical fees for the people to both undermine your competitor and capture the, whoever this superstar or multiple superstars are. Do you not see that longer term as a sort of a trend?
I think it's possible. We've seen this wave in prior periods where there were great programmers or people had great ideas on software strategy, where technology companies have been looking to hire the person or the group of people for a long time. As you think about the broad M&A market, though, I think it's much more about companies over time. There'll be periods and windows where there might be an idiosyncratic ability for certain talent to have a huge impact. But we've seen these cycles before. And in the end, it comes back to, I think, broader corporate franchises.
Jamie Dimon has said he's concerned about the hot private credit markets. Are you concerned at all on that front? I won't comment on Jamie's comments, but when I think about the private credit, I look at it as, it is
it met a client need, and it does meet a client need, and it's a very large market now where, in the end, it's one market. We've been doing private credit through our mezzanine funds for 20 or 30 years plus.
Right.
So it's not something that's new. It's obviously bigger than it was, and we need transparency in markets. But again, it's one market, not multiple markets. But private credit served a purpose. Private equity was able to directly negotiate. It serves in certain purposes, and it doesn't serve in others. But it's one part, to me, of how private equity is financing or other companies are financing their balance sheets.